Hi everyone, welcome to the Fifth Person's live webinar. My name is Rusmin, and tonight we're going to discuss whether long-term investing strategies still work for us in the 21st century. Okay, so before we begin, I just want to make sure that all of you can see my face and can hear my voice loud and clear. And if you do, please let me know in the chat box. And of course, we started this session a little bit earlier, and we're gonna start the content straight at 9 p.m. Okay, so thank you so much, Jaden, Elvin. Yes, so a lot of you actually apparently can see me. I hope you enjoy the little nice background over there. So, yep, cool. All right, so we will wait for the rest to join us. Okay, and we're gonna start this at 9 a.m. If you need to grab a glass of water, please do it so, or you need to go to the toilet, please do it so, because this session is going to be about an hour long, so there will not be any break in between. Okay, so also if you have any questions at the start of the webinar, you can type your questions in the comment chat box. Okay, so I will try to answer all of them. And because if you don't ask these questions, then we're going to end the sessions a little bit earlier tonight. Okay, so please type your questions and we will continue to wait for the rest to join us. Okay, so, and I'm going to change it to my presentation slide. And if you can see my presentations, please let me know also. All right. Okay, can you guys see my screen in front of you? Yes. Okay, thank you so much, Adrian and Juliana. All right, so it's 9 p.m. Okay, so I'm just going to switch myself in again so that you can see me. And I'm here at Orchard Road, so you can see a very nice background over there. And a very good evening to all of you here. And tonight we're going to talk about long-term investing, whether this strategy still work in the 21st century. Okay, so for this webinar to last for an hour, okay, I need you guys to ask questions. Okay, if you don't ask me questions, then you're going to end up earlier. And just for those of you who just joined us, my name is Rusmin, and I'm the co-founder of the Fifth Person. Okay, so let's go straight to the content, and I'm going to switch out myself to the presentation slide that I'm going to present to you. It's going to take you about 20 minutes. Then after that, we go through questions and answers. Okay, so let's begin. Okay, all right. So so it's 9 a.m. now. Okay, 9 p.m. Okay, all right. So now this tonight topic is going to be does long-term investing strategies still work in the 21st centuries? And before I begin, usual disclaimer applies. Whatever I'm going to share with you tonight is only for educational purposes. Okay, it's not a recommendation to buy or sell any stocks that I mentioned here in this webinar. Okay, so the first question that I have for you is, of course, how do you define long-term investing? Okay, so basically, how long is long? Okay, so can you guys give me some idea? What is your definitions of long-term investing? How long? What is the range typically that you are expecting to see a return? All right, so some of Senko says that his investing strategy is about 10 to 15 years. Anyone else? Okay, so I've got 10 years from Grace. Alvin, you've got at least 5 years. And then we've got Roy, 20 years. Nice. Okay, Michelle is about 3 to 5 years. 5 years. Okay, Jen, 5 years. All right. So hi, William. Okay. So okay. Generally, there are a lot of answers. But okay, Adrian, you slightly more than a year. To you is a long-term investing. Lawrence. Okay, you've got the right answer. And Mariana, you got the right answer. The actual answer is 6 each. That is supposed to be a joke, but some of you got the wrong. Got the right answer. Okay, so generally, long-term investing, for me personally, is about 5 years to 10 years. Okay, so some of you have I don't see any answer about in months, okay? But actually, if you go out and ask those people who invest on the street, you won't be surprised that a lot of times their investment horizon could be in days. They buy stocks today, they hope that it goes up next week. They actually want to cash out immediately. Some of them sometimes could be in weeks, and sometimes it could be months. And of course, long-term investing is usually in years, okay? But one thing for sure for everyone is that long-term investing is certainly not forever. Okay, so first, of course, if you want to invest for long term, you need to know what type of investor you are. Okay, so short term investors, typically you have short term horizons about ranging from a few hours. These are usually for traders, and sometimes it could be in days, sometimes it could be in weeks, and sometimes it could be in months. Okay, and whereas for long term investors, this is the part where we look out for good businesses and we invest for long term, and typically about 3 years, 5 years, 10 years. And fortunately, a lot of you actually got it right. Okay, you got a good answer, and I'm very happy that a lot of crowds tonight, all of you are actually a long-term investor. Okay, so the thing with long-term investing is that recently, or if you just started 2-3 years ago, you may not see the kind of result that you want. Okay, even though it has been 1 or 2 years, because recently over the past 2-3 years, market has actually came down, and some of you may be actually quite depressed because you're not seeing the result. Actually, it's quite common with long-term investing. So the most important thing is that don't give up. You need to stay. You need to have a convictions. Of course, you need to have a right strategy to begin with. Okay, so I'm just going to go through a little bit of statistic and also a little bit of research. And this research is actually being done by this dimensional fund advisors. So they actually did a sample research on long-term investing on a basket of stock they actually use to measure and then classify them as small cap and large cap. Okay, generally when they measure this performance from 1928 to 2016, small cap companies usually tend to deliver good results over the long term, and it's about 12% as of from 1928 to 2016. And small cap company, again, from their research, actually outbid those larger companies. Okay, so this result is very consistent throughout the US market and also the developed market, excluding US market, and also the emerging markets, right? So, and then I will just cover a little bit on the value growth stock, because long-term investing, there are a few strategies that some of you may use. Some of you use income investing, some of you use value investing, some of you focus a lot on tech companies. That's typically fall under growth investing. Okay, so even for this research that is being done, value growth stocks actually over the long term has shown outperformance against growth companies by about 3.6% in across other markets. Okay, so basically value investing is still the strategies that work the best over the long term, and this is based on their research. Okay, of course there are a lot of evidence out there, and I'm just going to pick one of them and to show it here. And dimensional fund is one of the evidence that I'm just showing you here tonight. Okay, and they also did okay, how they define value stocks. And growth stock is basically they base it on their price to book and price to earnings ratio. So they actually use a basket of the top stock that is actually traded at a low PE and also at low PB, and then they measure it over the long term. Okay, so this is how they actually got the answer. And also they have this measure profitability. This is in terms of return on equity. So they measure the operating profit before tax, depreciation and amortizations over the equity value of the company. Okay, so and they also found out that the company that can deliver higher return on equity generally perform better over the long run versus those companies that are returning a low return on equity. Okay, so generally this is a data that just basically to prove that long-term investing still works today. And if you hold it for, and of course a lot of fund managers will tell you that past performance is not guarantee of future result. Okay, so all this data is historical. Okay, so what is matter, of course, is the future, whether this strategy is still going to work or not. Okay, so generally if you ask me, I'm still good believer in long-term investing, because you need to be an optimist person to believe that the world is going to get better. If not, long-term investing, it may not suit you. Okay, so generally I believe that the world is going to get better year after year. Okay, that's why the business will start to prosper, people start to continue to do well, and we become more efficient. Businesses will also start to make more money. Okay, so this is in general. Okay, and the reason why I stick with long-term investing is also mainly because of the compounding interest. Okay, the power of compounding interest is the reason why I invest for a long term. And as you can see that according to their research also, if you invested $1 in 1926 and you hold it for about 90 years, your $1, if you invested just from inflation alone, your $1 will become $13 today, okay, just based on inflations. And if you invested in long-term government bonds in the US, then you're going to end up with 134. Okay, if you invest in large cap companies, this is where I usually call them as a blue chip. This is where you're going to have about 6,000 times in return. Okay, but if you invest in small cap, as you can see that your return is going to be much more. Okay, so long-term investing works solely based on the compounding interest at work. So the longer that you hold, the better your result you're going to get. Okay, so sometime in the short term, you may not perform really well. Okay, so basically my point here is that long-term investing strategies still work today, even for myself. And also a lot of research have done. Every year they will come out, publish this research that value stock outperform any other type of strategies out there. Okay, and this have been very consistent, and it's also the reason why Warren Buffett be so successful today, because he has been investing for almost 50 years, and yet his result is still very consistent until today. Okay, but of course, long-term investing, we all know that it is a no-brainer. Okay, and okay, so some of you are actually, wait, before I go on, some of you are actually saying that the screen is not maximized. Okay, can you see the screen is better now? It's in the full screen now actually. Okay, cool. So it's working now, right? Okay, so let me go back to the slide. Okay, so the questions now is, of course, a lot of time, long-term investing strategy still works, okay, but there is an execution problem that I find with a lot of people. Basically, long-term investing, there will be some issue that you may face along the way, mainly due to the execution problem. Okay, so some of the problem that you may face along the way is, of course, people getting impatient nowadays, because long-term investing is really long. And when we talk about 5 years, you're talking about a long time. Okay, and to wait to see a result in the 5 years and never see your wealth actually growing that much, and that is something that a lot of people can lose the patience easily. Okay, and the second problem I also notice is that a lot of time when we do long-term investing, sometimes we can be really overwhelmed by a lot of noises. So nowadays we are exposed to social media, newspaper, and all that, and all this can actually cause a lot of confusions. And of course, the third one is the emotional, and this is a journey that can be quite emotional and it's very lonely, because when we hold stock for a long term, we have to go through ups and downs, and this is the part that can become very difficult. Okay, so let me go through the first one first. And the reason why I say that people get impatient over long-term investing is mainly because I've got asked a lot of questions regarding this, and a lot of time I'm actually quite disappointed, or rather, I think people need to get educated. Okay, and this is just one typical example where people actually email us and thanking us for we send him some stuff. Okay, so basically he thanked us, and then later part he actually wrote some of the stuff that he bought 200 share in Venture. Venture is a Singapore listed company at $20 2 days ago, and he sold it for $21. Okay, and just a day after, and he made a profit about $20 lah. Okay, so I think this guy, of course, generally he needs to go through proper course, okay, to understand what is really investing, because we don't really believe in short-term investing, and short-term investing doesn't really work. And so far, statistics have shown that long-term investing is much easier for us to duplicate the strategies versus trading. Okay, so this is really a big problem, because I also encounter issues like, I talk to some of my friends who have no financial knowledge in investing. A lot of time when they invest, they are very short-sighted. the moment they enter into one stock, they actually expect that to go up in a matter of days or months. Okay, so this is really something that you need to bear in mind, and you should not invest based on that. Okay, so this is just one of the examples that I just want to see you. Okay, and Munger always says that it's waiting that helps you as an investor, and a lot of people just can't stand to wait. Okay, if you didn't get deferred gratification genes, you have got to work very hard to overcome that. Okay, so this is something that is a big challenge, and a lot of time get actually impatient. They don't want to wait. Okay, so this is the problem that if you are doing long-term investing, you need to be able to overcome this issue. Okay, again, I just want to show you some hard statistics for you to stick with the long-term strategies, and they actually did a research also over the same period from 1928 all the way to 2016, and they actually compare this stock market with across different instruments, the T-bills, the treasury bills, which is literally risk-free, and they actually discover that in some years the market will outperform the treasury bills. In some years they may actually underperform. Okay, so if you were to invest for 1 year here or 2 years here, you will see a very disappointing result. Okay, so and of course in some years it may outperform. So in the short term, stock market is very, very volatile. Okay, so you can't really invest successfully if you are just coming from a short term point of view. Okay, and they also did a research on small cap versus large cap, and small cap generally outperform the larger cap, but only in certain years, not in all the years. You can see some years they underperform, and some years they outperform, and some years they downperform. Basically, the red is underperform, and the blue is actually outperform. And also the same thing for value investing strategies versus growth investing strategies. In some years, it may actually work really well, and in some years, it doesn't really work very well. Okay, and if you invest in stock that give you very good return, and you can see that in some years, it deliver very well. Okay, this is just from 1 year horizon. Okay, so meaning to say that you buy a stock today and you hold it for a year, you may see this kind of result, sometimes up, sometimes down, sometimes up, sometimes down. Okay, so it's quite common. But if you were to invest in stocks, relatively good stocks, okay, after your deep analysis and all that, and you hold it for about 10 years, you're going to get to see your return almost very obvious in a 10 years time frame. Okay, so this is what they've done in a 10 years time frame. So if investor in the stock market for at least 10 years, they will see the result very clearly. Okay, so like let's say if you invest here and 10 years later you will start to see a result somewhere like this. Okay, but of course if you invest somewhere around here, all right, 10 years later, you may see underperformance whenever the market big crash. Okay, so this is the part where people start to give up and they lose their patience and they sell out everything. Okay, so this is the big problem that we need to address. You need to be aware. Okay, and also I want to let you know that if you continue to measure your performance on a yearly basis, you're gonna have a disaster, because if you measure your performance here, okay, let's go back to the last year, and you give up in 1 or 2 years, then this strategy is not going to work for you. Okay, but if you hold it over long, 10 years, your odds of getting right is actually very, very high, and the outperformance is also very, very high. And the same for small cap and large cap. Okay, you get to see a lot of blue bar, meaning to say that you are actually seeing your return. Okay, and the same for value and growth strategies. A lot of time, value strategies outperform growth in many years. Okay, so you see a lot of growth, and this is, of course, you must hold at least 10 years. Okay, and again, also high profitability and also versus low profitability. In most years, company that can deliver higher return on equity versus company that deliver lower return on equity actually generally outperform most of the time. Okay, so this is statistics that they have done. So basically, if you can invest for 10 years, and your odds are very high that you will see a very good result. Okay, out of all this result that they have done. Okay, and this is a very long statistics. It's over almost 80 years to 90 years long. Okay, so this is really based on academic research. And of course, if just to give you some tidbits here, okay, so if you were to invest 10,000, basically the blue dot represent 10,000, and you hold it from 2007 to 2017, okay, this is what you're going to end up with your investment value, the one that in pink. Okay, so if you invested in Netflix in 2007, this is at a time when the market is actually at its highest. And despite the fact that you invested when the market is at its highest, you invest in the good companies, their performance will start to show up. Okay, so like Netflix is one of the biggest performer. Amazon, your 1,000 become 12,000, and Apple, your 1,000 become 6,000, and Starbucks, your 1,000 become 4,000. Okay, so the same thing goes for this, and of course your return. If you invested in GE, your 1,000 become 490. Okay, so not all stocks going to give you positive returns. There are stocks that are going to turn sour along the way. Okay, so of course later this is the part we handle later, where we need to do portfolio diversification. Okay, and this is probably the most important slide that I want to show you tonight. Okay, so you might want to take a screenshot on this because it's going to be very, very valuable. But basically, what they have discovered by doing this entire research from 1926 all the way to 2016 is that if you invest in the stock market and you hold it for 1 year, your chances, your odds is going to be you're going to get the chances for you getting the right investment, see positive result, is going to be 69%. Okay, but if you invest it for 5 years, okay, your chances of seeing positive return is drastically actually increased to 77%. Okay, if you hold it for 10 years, then you're going to see about 85% chances of getting right. Okay, if you hold it for 15 years, you're going to get about 95%. Basically, your equity will outperform the risk-free rate instrument. Okay, in US we call it the treasury bill. Okay, so this is something that you might, which is very, very important to take note of. Okay, and the same thing for value and growth strategies, and small cap, be it large cap by a big time, and also high profitability against be the low profitability. Okay, so this is really, when I saw this chart, I say that this basically is the proof that long-term investing really works very well. I mean, the longer you hold, the higher your chances of getting success in the stock market. Okay, so now the question is, of course, I have actually pointed out that it's not the issue with the long-term investing strategy. The issue is always the executions. Okay, people get impatient because in 1 year they start to judge their performance, and then they start to realize, hey, investing is not for me, and then they will start to give up. Okay, they move on, then they stop doing investing altogether. All kind of cases that you may actually hear that people may actually face. Okay, so now the question for you is that how to become more patient in the long-term investing. Okay, can you give me some suggestions so that I can give people, advisors, every time they come to me and they say that, Rusmi, I bought this stock, the share price dropped by 20% over the last 6 months. Should I hold or not? So these are the things that I usually try not to bother, but sometimes they come to me, I still have to give them an answer. Okay, so if you have been investing for long term, okay, can you share us some good tips on how to overcome this issue about getting impatience? How do you overcome it yourself? Okay, so just give me some idea. Okay, so I'm going to pick up the answer which I actually agree. Okay, so some of you actually bring up answers like okay, Adeline okay, basically suggested that don't look at the share price. Okay, so after you invest in a stock that you believe that it is reasonably priced and the stock has a good business model, a good economic advantage, and they have a long runway, you just don't look at the share price. And this is really something that I apply myself, and I hope that those of you some of you may along the way you may actually encounter this issue. Okay, so just remind yourself not to look at the share prices every day. And Alistair, okay, actually says that you should just monitor your share price once a month, okay, instead of daily basis, because this is the time where you become very emotional, because when you see your share price after you invested comes down, sometimes you start to tell ourselves that, hey, this is wrong. Yeah, I shouldn't invest in this company, I should have bought it later, stuff like that will happen. And this is where you're only making yourself confused. Okay, you should stick to your investing thesis about this company, and you have to hold it for at least 3 years to 5 years. Okay, so and Roy actually suggested that Okay, Roy suggested that we should only look at income stock if you are not, if you consider yourself impatient, we should just look at dividend stock, because this dividend stock will actually give us a very steady dividends, and we can actually spend the dividends. Okay, so that will make you feel better. Okay, so that works for Roy. And okay, Kam Seong also say the same thing. Dividend investings much better. So they actually, some of you, I believe that you have tried both capital gain investing strategy, basically the growth investing. Just to answer Grace, basically the growth investing is where you invest in companies that are growing very fast, and your main focus is basically capital gain. Okay, so you aim to double up or triple out your money. Whereas for value investings or income investing, which I find they are very similar, where you invest in stock that actually give you very steady dividends, and you buy them at a reasonable valuations, or sometimes below the valuations that you actually estimate. Okay, so Tham also suggested that focus on the fundamentals of the company, okay, which is the right answer. So sometimes when we invest in stock, okay, the share prices may change every single second, okay, every single day, the moment we start to trade, okay, but that doesn't mean that the business of the company start to deteriorate every single second. So it's no, okay, so we just have to look at from a long-term perspective, okay. So okay, there are a lot of answers, so I'm not going to elaborate all of them. Okay, so a lot of you say that don't check your portfolio every day. Jaden also say the same thing. And Mr. Ong, okay, Ong Seng Heng brought up a very good suggestion. You should read books about value investing to remind yourself to be more patient, okay. And Robin also suggested a very good point. Invest money that I can lose, okay, which is a good thing. Okay, so some of you have a similar answer. Faith actually says that every time you think of selling, do an analysis of the company. Okay, soon you realize that you were tired of doing that. Okay, and okay. All right, so a lot of you have a very similar answer. Okay, so Marco, later I'll come back with your questions. Okay, so basically, I'm going to move on. So basically, try to convince yourself not to get distracted by the share prices fluctuations here on a daily basis, because this is something that you can't escape that. Okay, so my take is that first, I don't usually look at share prices every day. I look at it maybe once a week, okay, or once every 2 weeks. Sometimes when I'm busy, I usually don't take a look, okay. But even when I take a look at the share prices, if it drop below the share price that I bought, I don't panic. I see it as an opportunity, okay. And I focus a lot on the process of my investings. So basically, I keep reviewing the company that I analyze and make sure that I don't miss out any important stuff, okay. So this is something that's more important: process. Okay, so result is something that you can't control in the short term. Okay, and Peter Lynch once said this: time is actually on your side when you own shares in a superior company. Okay, so that's also where I focus a lot of attention on, and my attention on finding good companies. So a lot of time I don't monitor company stocks, share prices every day, and this is the part where it makes us getting more impatient and stuff like that. So focus on finding good companies, and at the end of the day, you will realize you're too busy with finding good companies. Okay. All right, and second reasons that I want to point it out is, of course, is the most common mistake that people make when you do long-term investing, and this is where a lot of noises come in place, and we may get distracted along the way. Okay, nowadays we have newspaper that's telling us that what is happening with the macro environment, and just 2 days ago I was reading, or in fact yesterday, we are all very aware that United States actually started a trade war with China, okay, and now China is actually going to retaliate back, okay. So all this trade war, okay, increase a lot of volatility in the stock market, and that actually caused some of us to panic, okay. So this is another one example that I just want to bring up. Okay, I'm not pointing out at a person or whoever, okay. It's very common, and it happens to a lot of people. I meet people at a workshop, on the streets, and my friends, okay, they are usually very fearful, okay. And Young is one of them, okay. I was just thinking of buying certain companies right now, but I'm very afraid that the market will go into recessions, okay. Should I wait for the recession to come and fetch a better price, okay? Can I say that with a cheaper price, I can buy a bigger amount of share with the same amount of money. Okay, wouldn't it be better? Okay, so basically Mr. Yong is trying to time the market. Subconsciously he's not aware of that, but of course I will have to remind him that you can't just look at things in that way. Okay, so a lot of time we focus on companies, make sure that they are trading at undervaluations. So when the macro environment start to go against us, meaning to say that a lot of company share prices start to drop, okay, that should be your opportunity to pick up those shares. Okay, and over the past 5 years or 10 years, okay, and I can show you some of the things that I've gone through. In fact, there are many more. I just want to bring out some of the main points here. We've gone through Brexit, we've gone through oil crisis, we've gone through trade war and China hard landing. And I think a few months ago, just a couple of months back, we are worried about Italian debt crisis. And all these things will keep on coming and coming and coming. Okay, it will never stop. Okay, they come in different form, and all these things usually instill fears in the market. And this becomes the big problem where investor will start to read this news, and then you start to worry whether should you buy or not, okay, or should you buy after these things happen, okay. And I can tell you a lot of time you'll be wrong, okay, because when events like this happens, a lot of time share price has already come down, okay, and that's where people become very fearful. And this is exactly the best time for us to pick up shares that we're actually monitoring, and because the prices of this company, the chances are high actually will have come down. Okay, just look at recently some of the companies in Singapore or in Malaysia have actually came down after for the Malaysia case is after the elections, and also in Singapore some REITs also have actually came down a lot because of the interest rate fear. Okay, so I just want to remind you that these are the situations that where we can't really avoid, and we will continue to face them. And what you need to see is, first thing that you need to do is that don't time the market. Okay, this event, whether you trigger or not, is not going to become true, or sometimes it could be true. Okay, but I don't generally spend a lot of attention on all this. Okay, so I usually ignore all this macro environment, and I focus a lot more on business trends. Okay, so what we are seeing, what I've just shown you previously, is basically the market trend. Okay, so this is where all the macro events is going on. The just most recent one is the trade war. Okay, of course you can still pay attention to trade war, because some of these companies are actually really affected by the trade war, especially those do export and import between China and US, like steel company, automotive company. Those companies will actually get affected. So if you invest in those companies, then of course you have to be more careful. You need to review those company, the portions that be affected by these changes. Okay, but a lot of companies that, in fact, I look at their portfolio, they are not really going to get affected by trade war. So I'm not really concerned generally because of that environment. Okay, so what I'm more concerned is, of course, on the business trend. Okay, this is where you need to be able to spot the changing business trend that's happening that quite fast in the 21st centuries. Like for example, no one's really know that business like Uber and Grab, car sharing service company like Grab and Uber, actually disrupted ComfortDelGro. Okay, ComfortDelGro used to monopolize Singapore market in the taxi industry. And because of the changes of business trend, because of the technology, consumers' behavior also change. The demand for car sharing, carpooling business actually started to pick up. And of course, this actually affected the ComfortDelGro business. And this is generally something, the trend that you need to monitor and to assess how the impact is going to get. Okay, and of course, industry like telco also can get disrupted by the Netflix. Okay, so for example, StarHub, we have trends like OTT, over the top content players like Netflix actually disrupted the traditional TV industry, because nowadays people can subscribe to Netflix and stream at their own time. Okay, and they don't have advertising. Okay, they don't have commercials time and all that, so people actually prefer to go for Netflix over the traditional TV industry. Okay, and they can watch the show that they want at their time, whenever they are free. Okay, so look out for business trend rather than focusing a lot of attention on market trend. Okay, and this is something that you should not focus too much, because you ended up your long-term investing strategy become very short-term, because these things happen very often, every few months and every few years. Okay, so if you focus too much on that, you will tend to buy and sell, okay, relative to the changes of the macro trends. Okay, so forget about this trend. All right, so and the third one is, of course, it's going to be the emotional journey. Okay, and when we invest for long term, okay, after we buy a stock, we have to wait for 5 years, and that 5 years can, a lot of things can happen. Okay, so, and sometimes when things doesn't go your way, we start to get disappointed, especially the performance. A lot of time is really boils down to the performance. Okay, and I heard this a lot. And tonight's session, I just want to focus on the share price performance. Okay, the share price, sometimes when it plunge after 3 years of holding, and you start to become very fearful or very scary. And this is the time also, I want to remind you that when you invest for long term, this is something that you face. Okay, you're going to have a very volatile stock market. So a lot of the stocks in the portfolio will start to move up and down. Okay, so don't get panic. And this one you need to overcome. And also volatility is something that is not just about going down, it's also going up. Okay, it's both way. So basically you need to overcome this thing. And I actually took up this slide from Deep Value Course, actually by Jin Hao, and he actually suggested a few things which I find it very useful, and I want to share it with you here, how to overcome this volatility. Okay, so first, of course, you need to have the habit of being greedy when others are fearful, okay, and be fearful when others are greedy. Okay, basically when macro environments like trade wars start to happen, share prices start to come down, valuations start to become cheaper, then there's a time where you should be greedy, you should be looking at stock, you don't panic. Okay, that's what Jin Hao suggested. And of course, second is that you need to assess the operating position of the company, not their share prices. Okay, again, a lot of you actually brought up the same point. Focus on the company's fundamental. Okay. And third, of course, don't invest in companies that have a lot of debt. Okay, because this is the time where you're going to lose your sleep. And also, don't look at your stocks from don't look at the stock from one stock point of view. Look at the entire portfolio as a whole. Actually, if you diversify your stocks into across 5 stocks, 10 stocks, actually I prefer to stick to 10 stocks. And usually you don't see that kind of volatility. Even if you have drawdown, you may have drawdown of 10%, 20%. But if you have a concentrated portfolio, let's say you only invest in 2 to 3 stocks, a lot of your money are inside, then you're going to see a very volatile portfolio. Okay, so my suggestion is that you need to diversify to at least 10 stocks for normal retail investor. Of course, the more money that you have and the older that you get, you must actually increase your number of stocks to 20, if not 30. Okay. And of course, the most important is that don't invest the money that you're going to need it for at least 5 years, if not 10 years. Okay, because long-term investing requires a long time, right? A long time frame. Okay, so this is also the last part where I just want to wrap it up. It's very important. And of course, after we invest for long term, you have to pray. And of course, praying, some of you may help. Okay, so I don't believe in praying, but most important is that you must have faith with the strategy that you're investing. Okay, so risk comes from not knowing what you're doing. So you must have faith in the strategies, and you also must know what you're doing with the strategies that you actually invest. Okay, so I will just end up my presentation, and I just want to answer some of the questions. Okay, a lot of you ask questions, so I need to vet through some of these questions. Just give me some time. Okay, so Walter basically asked, what is the leverage industry? Okay, so basically I think Jin Hao is actually referring to companies that are generally leveraged, meaning to say that they take on too much debt, because this is a time where they may be in trouble. Okay, so just to give you one example, companies like HiFlux or Swiber, and those are companies that actually took on too much debt. Okay, so when their business start to do poorly, okay, they have problem paying up the debt, and that's the time when the company will start to go for bankruptcies. Okay, because they need to liquidate some of the assets to pay back the debt. Okay, so a lot of businesses are killed because of taking too much debt. Okay, so Louis asks, okay, what happened when the business trend change, but you are dollar up with that sector? Okay, so in this case, you need to get out as fast as you can. Okay, So like for example, if you invested in StarHub back in 3 years, 5 years ago, of course now I'm saying on the hindsight, okay, I see some good investors that they actually invested in StarHub for almost 10 years, 20 years. They actually sit on very good result. They have received very good dividends since StarHub went IPO, and they actually sit on a very good capital gain. Okay, there's one particular lady that I saw, actually she posted on her blog that she sold out her position on StarHub because she realized that the industry has been disrupted by companies like Netflix and internet. Also nowadays can actually people call the international call. They can actually call it through WhatsApp or WeChat actually for free. Okay, so the moment when you realize that the companies that invested got disrupted, okay, it is better for you to get out. Okay, so this is also the time some of you may lose money, but you have no choice but actually to cut. You have to cut the investment. Okay, so as an investor, you are not tied to the business. Okay, you are free to allocate the money to an industry that where you think the future is going to get better. Okay, so generally I will cut the business. Okay, so Alfred asks, in terms of valuations, what should one be looking for to be able to make informed decision to select and buy certain counters? Okay, so this Alfred, this will depend on strategies that you are using. If you are doing income investing, you can look at historical dividend yield, the high yield and the low yield for a particular stock. Okay, so this is generally what I will apply for myself. But of course, if you want to go deeper, you can actually start to look at PE ratio, price to earnings, or you can use price to cash flow. And sometimes for asset-based company, you can use price to book ratio. Okay, so this few valuation method that you can use. And of course, I can't go in depth into that because that is going to take me another few hours to actually explain to you. Okay, so and generally, let's say if I look at one company, okay, for example, I invested in BreadTalk. Okay, so BreadTalk is companies which I invested a long time ago. I think in 2012, I bought it at a price to adjusted cash flow of about 4 times. Okay, at the time when I look at the industry average for the same comparison on price to cash flow, companies like Japan Food, Soup Restaurant, Old Chang-Kee, they were trading at about 10 times price to cash flow. Okay, so and this is also the time when I know that BreadTalk is actually trading below its peers. Okay, the price to cash flow is actually significantly below the peers, the BreadTalk peers that are actually trading. So this is also one area where you can actually do your valuations, relative comparisons. Okay, so and Amy asks, when the general market is moving down, it is difficult not to be tempted to look at share price. Okay, better to go back to look at fundamental to reconfirm the investment thesis. Okay, so Amy is not, she's not asking, you're not asking the question, right? Okay, you're just referring to the, okay, so Marco basically asks, do you consider trade war as noise? Okay, so this is something that I think it is a noise, okay, but of course it is not a noise if you invested in those companies that are affected by trade war, the tariff that actually implemented, like automotive industries, steel company, aluminum companies, and of course you need to go through the list of companies that actually the list of industry that actually if the tariff increase the tariff, and this will actually affect those companies in export and import business. Okay, so for me, because I generally cover a lot in Asia, or if you invest, let's say in technology companies like Facebook, trade war is not something that you're going to worry, because people spend money on advertising. It's not going to affect this tariff. Okay, so it's not the things that you should be worrying if the companies that invested are not affected by that. Okay, so this kind of macro event usually will affect a lot of companies, not just those companies that is related to the trade war. Okay, so let me find through. Okay, I see a lot of questions, so I need to be able to find some of the questions. Okay, Walter asks, how do you find stocks like Netflix, which give a very good return? Okay, this is $1 million questions, Walter. Okay, this is a questions that of course we are looking out for these companies every day. Generally, I don't Netflix is considered a growth company because they don't really generate profit. Okay, so the strategies to invest in companies like Netflix is very different. That one you need to look without a little more on growth investing. Okay, so at 5th% we don't really focus on growth investing strategy. Okay, we being asked, this webinar will be available after today. Yes. Okay, we will send it to you, record versions. Okay, so let me know if you still have questions. Okay, Terence asks, okay, this is very company specific. Okay, some of you may not know. What is your view on the Hong Kong Costco shipping group? Okay, so this is the company that is listed in Hong Kong Stock Exchange. It's not the Costco Singapore, it's the Costco Hong Kong International. Okay, so this company, it is a company that I think is a deep value stocks. Basically, the company is trading at a huge, or rather below the cash level of the company, that basically the market cap of the company is actually trading below the cash level. Okay, so if you ask my opinion, and I think this is the company that is grossly undervalued. Okay, so I'm invested. So those of you who are interested, please go and do your homework. Yep. So generally, this is a deep value stocks. Basically, they generate a lot of free cash flow. It's an asset-light business model, and yet they actually are sitting on tons of cash, and it's trailing below the cash value. Okay. So let me go up to some of the questions that you have at the start. Okay. Sanko asked me, is investing in STI ETF considered long-term investment? Okay, so STI ETF index, okay, of course you can also invest in the index, and in fact the previous research that I showed you earlier is actually based on index investing. Okay, they actually took a basket of stock and then they actually measure the performance. Okay, so indices, ETF, all that generally work also over the long term, but you can't buy STI ETF index today and you hope that it goes up tomorrow or next month or next few months. Okay, so it doesn't work that way. You need to hold it for 5 years, 10 years to be able to see the results. But for index return, usually you don't expect a double-digit return. You can only expect a return between a single-digit return over the long term. Okay, so this is from what they have shown. They have researched over the past 100 years. Okay, so there are more questions at the back. Okay, so right, I'm gonna ask. Okay, Mansing. Okay, hi Mansing. Mansing actually asked, for long-term investing, isn't it better to invest in blue chips than small caps, since small caps are more prone to failures? Okay, small cap companies generally in Singapore, I will classify them as below 500 million market cap. And in Malaysia, of course, it's about below 500 million. In US, small cap companies generally below 500 million also. Okay, so I don't really quite agree that if you were to invest in small caps, okay, the chances are high that you're gonna subject to failures. Okay, of course, small cap, the odds, the chances for them to fail is much higher. Okay, that is generally true, but you should only invest in small cap companies if you are able to find good companies. They have good economic advantage. They have operating the niche business. They have a long runway. I think this type of company generally they can perform better and they can become more successful. Okay, and usually they must have a good track record of at least 5 years to 10 years. Okay, so that actually siphon out a lot of small cap companies that are actually not profitable. So by doing this process, you actually eliminated a lot of junk companies that are categorized under small cap companies. Okay, so there are small pool of small cap companies that are actually very profitable. Their business, they have a good business model. Okay, so this is the group of small cap that we should be focusing on, not every small cap. Okay, and of course, blue chips nowadays are also under a lot of pressures. Like I said, ComfortDelGro, SPH, okay, even the Star Media in Malaysia are also under threat by the disruption that's going on. Okay, so nowadays blue chip is no longer blue chip anymore. Some of them are blue black chips. Okay, so there are other questions. Okay, Shan Yan asked me, what is your view on Singapore REITs now? Okay, so REITs in Singapore over the past few weeks or rather few months have actually came down, and I think their valuations to become more attractive. And those of you who have a list of watch list of Singapore REITs, you should actually look at them. And I think generally they are trading at a good and attractive valuations. Okay, and a few of them, I don't want to name names just in case some of you buy based on my stock tips. Okay, actually trading at a historical high yield that was last seen in Euro debt crisis. Okay, so just go and have a look at those REITs. And with the rise of interest rate, I don't think it's going to affect everyone. Okay, you only affect those REITs that their leverage are generally very high. Okay, they have a gearing ratio of, let's say, more than 40%, and a lot of their debts are actually are floating in nature. Okay, so REITs like, of course, Suntec REITs, you get to see their debts profile. A majority of the debt are actually floating in nature. Okay, so that may increase the likelihood of their borrowing costs if the interest rates start to continue to go up. Okay, so generally for REITs in Singapore, to stay safe, you need to look at REITs that have financially they are very conservative. They don't take on too much debt. Okay, so that is be the most important criteria. And second, of course, you need to look at REITs that have assets that are located in the good locations. Okay, and of course, there's a list of process that we cover at Dividend Machines. I can't go through all of them with you here, but these are just two things that you need to take note of. Okay, so let me go through some of them. Okay, wait, so you still have more questions coming in. Okay, for long-term, okay, Juliana asking me what is the stock code for Costco Shipping Hong Kong. Okay, let me go and take a look. What is the stock code? All right, so general share price. All right, so here we can see that this is the company share price. Right, so yeah, hopefully I answer your question. Okay, so this is 517. Okay, so now let me see whether I still have questions. Okay, so what is your opinion on robo-advisor? Okay, so I don't personally invest in robo-advisors. Robo-advisors is basically a passive investing. If you know what you're doing, of course, you wouldn't go to robo-advisors, but if you do not know what you're doing, and if you want to diversify a part of your portfolio to robo-advisors, and I will only encourage you only allocate a small percentage, because robo is really asking a robot to help you to structure your portfolio based on your risk appetite. And generally, the track record for robo-advisors is still very short, and a lot of them are actually based on the research and statistics to actually back up their data. Okay, and well, I don't have a confidence with robot. I have more confidence in myself. Okay, so if you know what you're doing investing, of course, I will still encourage you to do it yourself. And Kevin asked, basically, raising interest rate mainly affect REITs in terms of debts. Okay, of course, it's not just debt itself. It affects in other ways like asset appreciation. Okay, so sometimes higher interest rate doesn't mean that the cost of borrowing will also go up. Sometimes when the interest rate is going up, the economy is actually doing well. So when the economies are doing well, some of the REITs actually can also pass down this higher borrowing cost to the tenants, because some of the tenants in the office or in the retail are actually doing well. Okay, so they were able to absorb this incremental cost of fund. Okay, so this is what we have seen in 2004, 2005, 2006, 2007 in Singapore. Rising interest rate doesn't mean it's always bad. Okay, it can also be a good thing for REITs. And of course, if the interest rate spikes to 10%, 12%, and this is also the time where you see REITs are be heavily sold down because they kind of spike. The REITs, the landlord couldn't pass that kind of sharp increment to the 10. Okay, so this is where you start to see DPU coming down. So of course there are risks in investing in REITs, so you still need to diversify your portfolio across different sectors. And sometimes people come to me that you invest in REITs, 100% of portfolio in REITs, and I don't think that is a good idea. And I generally prefer to invest in REITs and not more than 50%. Okay, generally I try to keep within 30%. But those of you who are close to your retirement, you want to have a better and attractive view, of course you may increase up to 50%, but I don't really think that beyond 50% is really a good idea, because REITs again is sensitive to the interest rate. Okay, Kenneth asked whether do you have any books or resources to recommend. Of course, there are good books that I can recommend. One of them is 100 Bagger. Okay, so let's go through this book, which I find that is also, it covers a lot of 100 Bagger book. Okay, so in case some of you are wondering what to read, I think this is a really good book. Okay, so I'll just go to Amazon. Okay, so go and read this book, and I find that it will show you how to find companies like Netflix. Okay, so hopefully, but basically the principle behind this 100 Bagger is really very good. Okay, so just go and read it if you have time. I just want to recommend you one book. I have a long list of books that I can recommend. Okay. Okay, Adeline asks, I know it may not be possible, but is there a chance that the share market will really collapse one day? And my answer is, of course, yes. But when is it going to happen? Nobody knows, and that is the problem. And because that becomes the problems, I don't generally encourage anyone to cash out everything. Okay, and I like to share these stories again and again because it happens to one of my friends in 2011. Okay, exactly the time when the Euro debt crisis happens. At the time, the market was just crashing down. STI dropped about 25%. Okay, so that was a huge drop. And he actually told me that he will rather cash out everything, wait for the market to drop even further, that the one that we've seen in 0809, basically 50% drop. And that's the time where he will come in. Okay, and by doing that, I think that strategies, of course, I didn't follow him because at the time when I did my valuation on all the companies that I'm following, it was actually very, very attractive, and I started buying those companies. Okay, so by trying to time the market, basically my point here is that you will end up getting wrong all the time. Okay, so I actually give up on timing the market. In fact, none of you should try to time the market because it's very difficult to predict where the market is heading to. Okay, all the things that we need to focus on is that we have to find a portfolio of good and quality companies that is run by good people, and financially they are very profitable. They generate very healthy profit margins, good return on equity, and they don't take on too much debt. Okay, and we want to buy them at fair value, if not under valuations. And when everything passes those criteria, we just have to stay with it for 5 years and 10 years. Okay, whether market will collapse one day or not, okay, it doesn't really matter, because the day may come, maybe 5 years later, 10 years later, even after it collapsed by 50%, the companies that you invested will have still make money by at least 2 times. Let's say you make 4 times in that company. If it collapsed by half, you still make 2 times. Okay, and this is also the time, of course, when they collapse. It's the best time for us to average down to buy more shares in the same company. Okay, so Joseph, would you share the slides with us? And of course, this video will be recorded again. You will be able to see the same slides. So is it advisable to include the recently listed bond, Astrea, that is actually endorsed by Ho Ching? Of course, rarely we see Ho Ching came out and say that investment is really suitable for retail investor. And this is one of the instruments that actually she came out and so-called endorse it, but of course she still says that this is not guaranteed by Temasek. Okay, And of course, if you have bond like that in your portfolio, the subscription is already over. I think it's a good diversification to increase your bond exposure, because that kind of interest rate is generally very attractive at about 4.25%. And on the day when it opens for trading, the share price for the bond actually went up because people thought that this is actually very safe. Yeah, so I think if you have no idea to where to deploy your money and you got a lot of cash, you can actually invest some part of your money with a very safe bond like Astria. Okay, so yeah. Okay, so let me answer questions from Amy. Okay, Amy basically asked, once we have invested in all of our capital, okay, what processes would you recommend to keep in place to monitor our portfolio? Okay, so once you have invested all your money, okay, usually what I'll do is that I will continue to monitor the companies that I invested at least once every 3 months. Okay, I'm considered more active. You can just go to the exchanges of those companies that are listed, like Singapore, or Malaysia, or Bursa Malaysia, or Hong Kong Stock Exchange, or US. You just go to those exchanges, just key in those companies that invested, and look at any major news actually happening. Okay, but if you don't have the time, of course, you must at least read the company annual report once a year. Okay, so this is something that you need to continue to monitor the stock that you invested. And secondly, you need to look out for news that are related to the companies that you invested. Okay, or news that are actually going to affect the companies, any of the companies you're going to you invested in your portfolio. Okay, so the idea again go back to, you need to be able to spot the changes of business trend. Okay, so by keeping yourself aware with the news, of course, don't spend your time reading on macro news, because those are noises that will going to affect your emotions in and out. Okay, so I usually will only focus on the news that will affect on the stock actually affect my portfolio. Okay, so, and of course, revisit your thesis once a year to make sure that the company that invested still stay the same. And also sometimes the share price of those companies that have gone up and may reach the valuations that you want to sell, we can actually cash out. But for good companies that with a long runway, okay, and good management that are running those businesses, I usually prefer to stick to it and keep it for a long term. Okay, so this is a thing that you usually do, and it's become very passive because you're just reading and reading, that's it. Okay, Jasmine asks, I'm a new investor. What is the ideal online platform with minimal handling fee that I can use to pursue for overseas stock? I understand that the best is to open an account in the local market. Okay, so if you're a new investor, if you're thinking to open a stock brokerage account, then of course, you can consider for reasonable rate, you can actually consider to look at companies like Interactive Brokers. Interactive Brokers is they don't have office here in Singapore, but they have operations in the worldwide. Okay, also in the US. Their main HQ is actually in US. And Interactive Broker, the rate is actually very, very attractive, and they don't have custodian fees. But of course, for that, you need a minimum of I think $10,000 to open it. So some of you may have a barrier of entry there. But if you have at least 100,000 US dollars, you can actually consider Interactive Broker. If not, you can only stick to local broker, and because local broker usually will provide you that kind of overseas network also, like brokers like Philip, CMB, Maybank. You still get access to that. And of course, Jasmine, don't worry too much on the handling fee or commission fee, because these fees are usually very minimal. Okay, if you don't trade a lot, okay, the fees are not going to eat up a lot of your return. Okay, so all these fees are usually very minimal. And if you focus on long-term investing, in 1 year you should be only buying 1 or 2 stocks or 3 stocks. Okay, unless it's a big crisis, you can actually buy up to 10 stocks. But other than that, you are actually very passive. You're not trading, buying and selling very often. Okay, so the fees is not going to eat up a lot of your return. Okay, Damien asked whether do I use any apps for tracking? And of course, the answer is yes. You can use apps like Bloomberg app. Okay, let me show you some of the app that you may have. Okay, so apps like Bloomberg, I think you can just download from your App Store, Android Store. You can track a list of companies. Okay, so this is really a good app. Okay, you can actually maintain a list, and sometimes they also pull out news. But of course, in the Asia, they are not very active. But in the US, they can pull up news related to the US companies. Okay, so sometimes you also have this app called CNBC, which I find it also very attractive. So it's a platform, something like that. Okay, where you can track, I think, stocks globally. Okay, so you also deliver news, and these platforms are all free. Okay, so of course, if you want paid services, you can go to Share Investor. Okay, so they do tracking, but Share Investor is only for local market. Okay, like Singapore or Malaysia. Okay, so they don't really have access to other market. They do have access to Hong Kong and US, but I find that they are not very comprehensive. Okay, so some of these services, but Share Investor is the paid services. Okay, so I'm just using the free app that's provided by CNBC and Bloomberg. Okay, so let me see what other questions you guys have. Okay, before I wrap it off, because now we are crossing 5 minutes. Okay, can you suggest? Okay, Walter asks. Okay, I'm just going to give you guys a favor here. Okay, it's not a recommendation to buy or sell. Okay, but since Walter asks, okay, can you suggest some good dividend stocks in Singapore Stock Exchange, which you can invest for long term? Okay, so this is hard questions, but I'm just going to give you one REIT. Okay, you need to do your own due diligence. Okay, and this REIT is trading at historical high yield, and this is my favorite. Okay, those of you who come for dividend machines, you will know. Okay, but I just want to show it to some of you here. Okay, and this is a company that you can consider taking a look. Okay, so all right, so I didn't mention any name. Okay, so I think you guys okay, you guys asked a lot of questions. Okay, apparently I'm running out of time, so I'm just gonna ask one last questions. Okay, so let me pick what questions would that be. Okay, I'm just going to answer these questions. Okay, Lawrence asks, how is the opportunities in Indonesia stock market? Okay, so a lot of you will not be investing in stock market in Indonesia, and I would say that opportunities, there are pockets of opportunities, but a lot of good stocks are still not undervalued. Generally, there are only a handful of stocks that are trading below their valuations. My own estimate of intrinsic value, I'm not going to share with you these names because Indonesian market is a little bit tricky because in terms of corporate governance, they're actually lagging behind. They don't disclose like how much the managements are paying themselves. So I don't really encourage retail investors. If you're not Indonesians, you should not invest in Indonesian market, especially we are talking about currency exchange. Okay, and rupiah has also been weakening against major currency over the past few years. Okay, so that's all I have for you tonight, and thank you so much for tuning in, and I hope that I answer most of your questions. If not, we still have a webinar coming up next month and a few months, just look out for our email. We'll invite you and ask questions, as many as you can before that, so that we can actually prepare some of those questions ahead. Okay, and thank you so much, and have a very good evening.